Well, good morning. Welcome to the fourth quarter. My name is Mike Horwath. I am the Chief Investment Officer at Diversified Lifelong Advisors, and I welcome you to our third quarter quarterly investment review and economic update. So as you know, we've been doing videos once a month and 4 times a year. So every quarter we like to get together and focus around the previous quarter and really a market outlook as well. So we want to go through what happened in the third quarter and what we expect, or at least predict generally to happen moving forward, not only in the fourth quarter, but also into 2021. So looking at our agenda for today, I'd like to go through real quick performance, asset class performance specifically, really a general market review, and then touch on a couple different talking points. One, let's talk through 2020 in general, the recession, the recovery, both very, very quick. So really talk through that, what that's looked like. Go through economic stimulus. I think this is an important thing to understand. So economic stimulus has been important from both the monetary side, which is generally driven by the Fed, and then the fiscal side, which is driven by Congress, and that's something that's been in the news quite a bit as of lately. And then flip gears a little bit to our expectations for the fourth quarter and into 2021, and a little bit on portfolio positioning. How are we looking at portfolios? What do we like moving forward, and why do we like that? And then wrap it up just with a quick summary. So let's jump into performance. Let's start there. So the third quarter was similar to the second quarter in that it was generally positive across the board. So if you look at this diagram right here, you're going to see that the top middle square, which represents U.S. large cap core represented by the S&P 500, it was up about 9% for the third quarter. You can really see across the board, and as you focus on the top right, that's once again U.S. large cap growth. So this has been a common theme for not this year, not just this quarter, really for the last decade, where U.S. large cap growth, which has been driven by big U.S. tech firms, continues to outperform. But by and large, we saw pretty strong returns in the third quarter. Small cap was up just about 5%, which are smaller companies, so it underperformed the bigger counterparts in the U.S., but both performed rather well. Flipping over to international was up just about 5% as well in the developed world. So when we say that, we mean Germany, France, the UK, Japan. The emerging markets, which are the more BRIC countries, Brazil, Russia, India, China, were up almost 10%, about 9.5% for the quarter. So it was an interesting quarter as it was a continued recovery across the board. We saw U.S. large cap and emerging markets lead the pack. But we saw both international developed and small cap perform pretty well as well. Flipping over to fixed income onto the bond side, we saw investment grade U.S. bonds up about 0.62%, and then U.S. municipal bonds about 1.23%. So bonds continued their upward trajectory, not nearly as much as we saw earlier this year, but they're doing their job. They're providing consistent income and providing a little bit of return in your portfolio. So where does that put us for the year? So if we look at where we're at on the year, it's a little bit of a different story, especially when you look at it from a grid standpoint, when you look at the different sub-asset class level. So we still see U.S. large cap, which once again represented by the S&P 500, but it's also, when we say that, it's pretty narrow. The S&P 500 is just big U.S. companies, right? Doesn't cover small cap, doesn't cover international, doesn't really take into account much of the growth value conversation either. So when we look at it, we see about 5.5%, which is not bad. But when we start to go down the capitalization scale, so as you go from large cap to small cap, we see small cap down about 8, almost 9% still on the year through 9/30. We also see international developed down about 7% and emerging markets down about 1%. So some of the more international firms and some of the smaller companies in the U.S. have struggled to really rebound. And not only that, when we look at what's performed well even in U.S. large cap, we say the S&P 500, but when we start to dissect it, value names, so value companies, which really encompass mostly energy, financials, materials, you think of the big banks, you think of energy companies with oil pulling back, large cap value down about 11.5% this year. So once again, the market within the U.S. has really been driven by U.S. large cap growth. Big tech, some healthcare have really performed well. Some of the communication services, so you think Amazon, also Google, Microsoft, Netflix, those names are continuing to drive markets. So it's been a very narrow market and what's performed well this year. When we take a step back, I think it's important that we look at this through the lens of a diversified portfolio. Right? A diversified portfolio, we're encompassing not only just U.S. large cap, but small cap, international developed, international emerging, and fixed income. Your returns for the year through 9/30 could be anywhere from that 2, 3, 4% range, depending on the amount of risk you wanted to take. Obviously, the more aggressive you were and concentrated in U.S. large cap, the better you would have performed. But a well-diversified portfolio on the equity side, still up, in the low single digits. And when we add bonds in there, low to mid single digit returns from a diversified investor. So kind of getting away from performance, let's look at 2020 in total. It's been a very interesting year, to say the least, from what we're dealing with and what we've gone through just personally, from our personal lives and everything we're dealing with there, but also from a market and economic standpoint. It's been a very rapidly changing year. So just to recap, early on in the year, we saw a peak to trough in U.S. markets, really from February 19th to March 23rd of about 30 to 34%. So it was a very quick, very deep recession that we saw in U.S. markets. And then we kind of flip and fast forward, the market has really since come up about 48, 49% through the third quarter. So it was a very quick decline in U.S. markets and a very quick recovery. Economically, we saw GDP down in the second quarter at about a 31% annualized basis. Very, very deep pullback in economic activity for the U.S. We also see unemployment, right? Unemployment coming into the year was extremely low. It was about 3.6%. I believe in February it got down to about 3.5%. Well, fast forward to the March-April timeframe, and we saw unemployment peak up around 14, 15%. It has since come back down around 8% to where it's at today. From a market standpoint, what's performed well, even though we say in general we saw markets pull back about 30, recover about 45 to 50% after March 23rd, it's been a very narrow market. What protected you on the downside and what's performed well, as I said earlier, has been a very tech-oriented, healthcare-oriented focus, mostly driven by an idea that stay-at-home companies, more tech-driven companies, are going to have very, very strong opportunities moving forward as the working landscape changes. Additionally, some of your bigger financial names and energy names have been affected by very low interest rates, very low oil prices. So it's been a very narrow market. It's been a very rapidly changing market. But things have recovered, especially within markets. Economically, we're still recovering. We want to see economic fundamentals catch up. What's been a really big impact has been economic stimulus, both on the monetary side and on the fiscal side. So when we say monetary, very early on, the U.S. Federal Reserve was very active in what they were doing to try to stabilize the economy from a liquidity issue and from a concern about economic growth and economic deterioration that we were going to see just based on economic activity going away with COVID lockdowns. So what did they do? They came in, they lowered interest rates to the floor. So interest rates are extremely low right now. We also saw them begin a bond buying program. The idea was to instill liquidity into the market so that they can really make sure that somebody else is on the other side as people are trying to not only go from stocks to cash, but from bonds to cash. So it was important that they stepped in and provided that liquidity, and they did so. Things stabilized from the Fed standpoint. We also saw economic stimulus in the fiscal sense from Congress, where they stepped in and they provided support for small businesses. They provided support for individuals in the form of a stimulus check. and they provided additional support for education and for healthcare. So a lot of stimulus to the tune of roughly $4 trillion has been pumped in fiscally. Now, the question is what's next, and this is what's in Congress right now, where the Senate Republican majority versus the Democrat House majority. They're at odds over what they want included, how big the bill should be. So this is something to keep in mind moving forward. Most economists really believe that for us to continue the path we're on, we probably need some more fiscal stimulus of some sort. Now, whether you want to say that's $1 trillion or $4 trillion, I think that's up to lawmakers. But in the end, additional stimulus is going to be needed to withstand some of the economic inactivity that we're seeing today. What do we expect going into the fourth quarter, really into 2021? We think it's going to continue to be a slow recovery. Coming into the year, we thought economic growth would be positive, but it would be slow. We still think that the economy is recovering, is going to continue to recover no matter who gets elected. I think that's important, that we still think that this thing is on a path for slow recovery, especially into 2021. But it'll be slow, and it'll really be dictated by what happens with COVID, what happens in the healthcare industry, and how quickly we can get a vaccine and treatment for individuals. So vaccine, we would expect also to be an initial boost. So I think getting clarity around a timeline for a vaccine will be important. I think it will be an initial boost to markets just from a confidence level. And we expect volatility from the election. I don't think there's any doubt that elections in general will provide a substantial amount of volatility. This one in particular, because of the very polarized nature, because we're in the middle of a pandemic, we expect substantial amounts of volatility. Now, that doesn't mean we need to go to cash. It doesn't mean we need to abandon our plan. It means we just need to have the right expectation that, look, volatility occurs at all points in time. Sometimes we can expect it, sometimes we can't. With the election, we would expect volatility, but we need to be calm, collected, be forward thinking, and realize that volatility in the month leading into an election is very normal. Volatility in the month after can be pretty normal as well. But as time moves forward, the markets become a little bit more focused, I should say much more focused, on economic fundamentals. And I think that's what's going to take over. So for the fourth quarter into 2021, we expect earnings to continue recovering. We expect 2021 earnings to be similar to where they were pre-COVID, and we'll see where 2022 takes us from there. We expect this recovery to be a slow and really dictated by the pace of what happens with healthcare treatments. So how are we positioning our portfolios in the wake of everything I just said? We look at it like we still prefer stocks over bonds. Now, we don't time the market from stocks to bonds, but when we're looking at do we prefer risk assets or being more conservative? If you look at valuations, if you look at how expensive bonds are versus stocks are still actually much more reasonably priced than bonds are. Bonds are expensive. So not that we let that dictate how our portfolios are allocated. We typically look more at our risk tolerance, our willingness, and our ability to take risk. But we want to understand that yes, stocks feel expensive. It's been over a decade of economic expansion, but stocks are still a good relative value to bonds. We actually still prefer growth stocks over value stocks. So I think it's natural that after so many years of growth outperforming, so many years of the tech sector outperforming, that you start to wonder, when is it time to abandon the tech names? We think technology, and it's not just domestically, internationally, is here to stay. We see a lot of innovation within the technology sector. We see work from home being a big impact there. We see 5G. We see a lot of market disruptors that can really be enhanced through technology innovation. So we really like technology. I will caveat this by saying we think that a vaccine and a return to somewhat normal environment will be a boost to the more value names. So when we say financials, when we say energy, some of these big, mature, a little bit more stagnant type of industries, we think that there could be some really good opportunity there when a vaccine is announced, once more of a defined timeline around treatments and vaccinations really come to fruition. So we're keeping an eye on that, both domestically and internationally, that maybe that there is an opportunity. And we're actually beginning to become a little bit more constructive on looking for that opportunity in some of those more beaten down areas, such as financials, such as energy, some of the material type of industries as well. Within the international space, we do right now prefer emerging markets over developed markets. We just see developed markets, some of the big European names, they're very reliant on some of those sectors that have been beaten down. They're reliant on more of those areas rather than technology. When you think about where technology thrives internationally, it's mostly within emerging markets and really emerging Asia. And that's somewhere that we're really focused on right now as an opportunity, as we look internationally for opportunities, because international markets are cheaper than the U.S. markets. So we're just trying to be very specific in where we're picking and choosing where we're taking our opportunities. But right now we like emerging Asia, mostly because of its tie to technology and technology-oriented type of industries. Within bonds, we do also prefer corporate bonds over treasuries. If you've been paying attention to the bond market through the first half of the year, you saw treasuries, so U.S. government bonds, perform really, really well. And that was because there was this flight to safety. As we've fast forwarded, if you go to open up a savings account, you see interest rates are very low. Yields on government bonds are very low. We just think there's more opportunity within the corporate bond sector, within other bond areas over treasuries. And that's where we're going to overweight our portfolios today. So kind of in summary, Q2, Q3 of 2020 have really been similar in the sense that they are part of a very quick market recovery from what we saw in the first quarter. Now, what we're looking for is economic fundamentals to catch up to where we see the market take off. Right? The market's really come back strong. Will we see the economic fundamentals? Well, we think we have to see that to sustain where we are today. But it's not surprising, because the market is much more forward-looking than the economy can be. Economic data a lot of times is backwards looking. So we expect economic data to really catch up to where markets have taken itself since the market bottom on March 23rd. Additionally, we're looking for unemployment and consumer spending to really improve. When we say economic data, that's what we mean, because I'm a broken record with it. 70% of U.S. GDP is driven by consumer spending. So consumers need to not only be working, but they need to be confident. So we're looking for both unemployment and consumer spending, consumer confidence to continue to tick upwards now that we're getting later and later into this pandemic, and hopefully closer to some healthcare treatment options and vaccinations. Lastly, we're really looking for a rotation a little bit in market leadership. And what we mean by that is, going back to the growth versus value, or the technology, healthcare versus financials and energy, we're looking for a little bit of a rotation there. We think some of these areas like small cap, financials, energy can really bounce back well if we have a better and more defined timeline on vaccinations and market getting back to normal. They're cheaper, but they're less growth oriented. And, I think people want to run away from the big tech names because they feel like they've become very overvalued. And I hear a lot of comparisons to, the 2000 tech bubble, but the reality is the companies that are leading the market right now are, very strong, very stable, high quality, so low debt numbers, and they have very, very strong earnings and a very, very strong consumer base. So we're just looking for opportunities both within small cap, rotating to value, also looking at emerging markets over international developed when we're looking for opportunities of where to invest next. Really just want to leave you guys with a quote. I thought it was very, very relevant today, just from an election standpoint. It's not necessarily tied to the election, but it has that connotation where Benjamin Graham, who is really the father of value investing, said, in the short run, the market is a voting machine, but in the long run, it's a weighing machine. And when he said this, he really was trying to imply that in the short run, market momentum drives a lot of things. right? A lot of times investors have a herd mentality where they flock to certain areas of the market just because other people are there, or because they've heard it's appreciating, or they're seeing others go there. Well, in the long run, earnings and cash flow are king. So I always recommend, when you're thinking about investing for the long term, don't just buy what sounds hot or what people are flocking to today. Look through, the high quality companies that have earnings and have staying power, have industry positions. And I think it's an important thing today when we're thinking about how we're positioning portfolios. So I appreciate everybody hopping on. I hope you found this valuable. I'll be back next month in November to go through our next asset class video, so we're looking forward to that. But until then, stay well, stay diversified, and look forward to catching up then. My name is Mike Horwath. I am the Chief Investment Officer at Diversified Lifelong Advisors. I appreciate everybody hopping on, and we'll talk then.